Hi, this is Robert Kiyosaki, and you're listening to Capital Hacking. This is the most important thing you can listen to today.
Hello, this is Josh McCown from Renault Winery Resort, and we have a very important announcement from Matt Sorenson about Learn and Grow, August 24th. Take it away, Matt.
I'm Matt Sorenson from Directed IRA. I'm excited to be the keynote speaker at the Learn and Grow event for Accountable Equity on August 23rd and 24th. Got to book your tickets and get registered. I'm excited to be there and to meet you in person.
Here's the one.
I have a dream.
With great power comes great responsibility.
I can do this all day.
This is it. Don't get scared now.
They may take our life, but they'll never take our freedom.
Cinderella story out of nowhere.
It's in the hole. That the only thing we have to fear is fear itself.
Capital Hacking begins in 3, 2, 1.
Welcome back to The Big Show. Josh McCown here with the world's best podcast host, John Edwin.
Hey guys, man, Josh, that was awesome with Mike Pine. He did an amazing job. He's one of the world's top tax strategists. Guys, you're going to get so much value out of this. I'm just going to give you a little teaser. He said he learned very early on working at a large firm that he wanted to start his own thing because he hacks taxes. Like we have capital hacking, we hack money, he hacks taxes. He said he loves the tax code. He doesn't shy away from it, and said that it's the yellow brick road to achieve wealth.
Yeah. You if everybody just heard what you said, they would be like, well, that's curious. That sounds very nice. How about the fact he's engaging I agree with you. You're going to learn you're going to learn, and it's not going to be painful because this guy is engaging. This is why so many of the people that I work with, is including investors with me, but also our entire company strategizes how to design funds with this gentleman, Mike Pine, so that we perfectly maximize the code for all the investors. And he loves it. He's always like, I love working with you. You're always asking me, how does the code going to help our investors? So you're going to find out what we like the guy. Oh, spoiler alert. He's going to be coming and meeting you. If you come to Learn and Grow in August, he'll be there. You get to break bread with the guy. He's great. You're enjoying the show.
Two other things I just want to hit on real quick. He does a great job articulating bonus depreciation. That's like a word that's thrown around and it's not defined a lot of times. And then he also articulates and defines how you can cost seg and save a lot of money on cost segregation.
Yep, he does a great job. Can't wait. Enjoy.
Let's go.
So my good friend and real important mentor and strategy leader, kind of one of my real teachers, Mike Pine. I never thought I'd get him on the show, John. So this is a big day for me.
You know, it's fantastic because Mike and I are just meeting for the first time right now, but we're both going to share a stage in August 23rd at the Learn and Grow together. That's going to be the biggest, best Learn and Grow yet for accountable equity. And Mike, we're just so excited to have you on the big show, Capital Hacking. Can you please give us a little bit of your background, who you are, and then we're going to ask a bunch of great questions, and we're going to help our listeners get tons and tons of wisdom.
You bet. You hack capital, I hack taxes. That's my basic introduction. I am one of those weird CPAs that absolutely loves the tax code with a passion. I don't see the tax code as being this noose around your neck like most people look at it. And they're wrong. The people who think the tax code is out there against you, or the tax code is something you should hide from or be worried about or be scared of, they are wrong. We have our own podcast where we're trying to re-educate the public to recognize the tax code is a yellow brick road to building your own wealth. It is there to incentivize particular types of investments that our society has agreed, if we do this together, if we can get entrepreneurs to go out and do this, this is good for our country. This is good for our national security. This is good for our energy independence. This is good for affordable housing. That's what the tax code was written for. Some people call it loopholes. It's not a loophole. It's the incentives that our society came together and agreed on through Congress. Our Congress can't agree on hardly anything, but they've agreed on the incentives buried in the tax code to try to invigorate certain areas of the economy.
Dang.
Like housing.
Dang, Mike, hold on. Before we get to your backstory,
bro.
I would say you came in hot. Nobody's disappointed. We get a hot take right at the beginning. There's never been anybody with better passion. I mean, you should get up on stage or maybe even the pulpit, brother. You are preaching it. We're so happy. We're going to start doing a revival dance back and forth. We'll be clapping. John's a great singer.
Yeah.
So, amen, brother. I can't wait to unpack all those hilarious things you said, but I want to let you tell a little bit about young Mike and how did young Mike get to mature Mike and have this epiphany?
We don't have long enough to go through the whole story, so let me give you an abridged version. I chose my degree and my major in accounting as a backup degree. I did not ever want to be a CPA. My grandfather, who was an amazing man, grew up through the Depression, barely made it. When I was trying to figure out what major am I going to pick in college, he said, there's only 3 professions I knew during the Depression had no problem putting food on the table. Doctors, lawyers, and CPAs. Well, my dad was a doctor. I hated how much he had to work and how little take-home money he took home after taxes. I didn't want to sell my soul and become a lawyer. I know there are some good lawyers out there, but not most. So I chose CPA, and I chose it because it was going to be my fallback career if I couldn't go do something wonderful in the world. Well, it turned out I got recruited out of college from PricewaterhouseCoopers Venture Capital and Private Equity Group. And I got to start my career. My first internship in 1999 was with PwC's VC and Private Equity Group. And I was working on some of the biggest funds that you heard of. I was getting to work with companies you could see all over CNBC back in the days. This was during the dot-com boom, and it was awesome. And it wasn't accounting, it was tax. Tax, if you practice tax, you really get to practice law without being a lawyer and losing your soul. I fell in love with it. So I started working there. I started my career at PwC. And after a year or two, I realized I was just working in a sweatshop. That's what the big firms do. Never get to see the big picture. Never got to have fun with tax. After a while, I went to a smaller firm where I got to see smaller businesses and really got to meet the people who were getting impacted hard by the taxes they were paying. They were getting impacted hard by becoming victims of the tax code. And at some point, I think around year 7, year 8 in my career, I saw the beauty of the tax code and realized what it's really meant for. They ought to have a better preamble to the Internal Revenue Code. It ought to say something to the effect of what I opened up the podcast with. It doesn't. It's pretty ugly and dry reading until you get into the hidden nuggets, until you get into those incentives. And once I got there and I fell in love with it and saw how powerful they were, I saw how my clients who've been working their whole lives to try to build a business and they were going to sell it and finally retire, they were about to lose half of the wealth that they had built up to the IRS. And I saw, but wait a second. There's this part in the tax code that says you have a small business stock. You don't owe any taxes. You see the lights that blink on to a client when you tell them that. You see how their eyes get wide open, and then you see their shoulders just pick up because so much weight has been taken off their shoulders, and they realize, you mean I get to keep some of, even most of the money that I've worked the last 30 years to build up? It was amazing, and I'm hooked on it, man.
Dude, is he the best, John?
He's the best. And you know, I didn't expect to come out of the gate that fast, and I'm excited because, you know, I'm just holding on for dear life. But Mike, so you're talking about not being a victim to the tax code, and you're talking about how they're, you know, I love that you said it's not a loophole, it's an incentive. Can you tell us some of these incentives that entrepreneurs can, you know, maybe they've overlooked, maybe their accountant hasn't told them about? Just give us a few of these incentives you're talking about.
Yeah, let me start off with one of the more obvious ones that probably everyone has heard of, but I'll tie it into how it works and why the incentive is such a good thing for our country. You guys remember, and you live up in the area in the Northeast, 9/11, September 11th, 2001, was the biggest tragedy in our current experience. We saw the World Trade Center tumble. We saw the stock market shut down for days. We saw all of the airlines grounded for days in this country. And the economy was shuddering. No one knew what that was going to do to our economy. We knew it was going to be scary. We knew it was going to hurt. We knew there was going to be a slowdown. We did not know how we were going to recover from it. But at that point in time, thankfully, we were more worried about not getting attacked again and let's making sure we're secure in this country. Well, in early 2002, if you guys remember, after 9/11, the Republicans and the Democrats stood on the stairs of the Capitol and they sang the national anthem together. I mean, they were unified. That was beautiful. And that unity lasted a little while, not very long, but a little while. In January and February of 2002, they came together and said, we need to do something to invigorate our economy. What can we do? And someone came up with a brilliant idea called bonus depreciation. And they said, hey, let's tell business owners who are scared right now to invest because they don't know what the economy is going to do. They're scared to make capital improvements and capital expenditures. Let's give them a deduction for those expenditures. Let's let them reduce their current tax bill. And in those days, it was a 50% bonus depreciation. They passed that. They made it retroactive to 2001. The first retroactive tax cut I'd seen in my career. I love those things. I mean, this is something where they write a law after the fact and they say, hey, if you did these cool things, you get taxes back. And it was awesome. So anyways, they did that. It was only a 1-year deal and it expired the next year. Well, they turned around and they realized and saw how much the economy was impacted by this bonus depreciation. They immediately renewed the law, only for another year or two. And then it expired again. Ever since then, it keeps expiring, and it doesn't matter if it's a Republican in the White House, if it's a Democrat in the White House, they keep renewing bonus depreciation. And it's been renewed, I think, 7 times since then because it works. It's an incentive. So I know that was a big, broader example of what you were asking, John, but the basics is this. They saw that, hey, if people will spend money in the economy, guess what? The economy keeps functioning. And people need to spend money to grow their businesses. So let's incentivize those businesses to spend money on capital improvements. I can't get it out today. Capital improvements. I don't know why.
I don't know. Capital hacking.
I like it. No, listen, I will say this, Mike. So many people get nervous to listen to CPAs, but I've never been nervous. I can't wait to put you in front of all these people traveling in to meet you at the Learn and Grow event in a few weeks, because the fact that you were able to show how that one came about through a moment of unity, it does actually crystallize the fact that they're not loopholes, they're incentives. That actually, from now on for the rest of my life, John, when I try to explain bonus depreciation to new investors, because we really work hard to design our funds to follow the code in a positive way. Yeah. And this is an important part for so many investors. So no listener can be left behind, Mike. What is bonus depreciation? What did we even talk about? Give an example of something we buy could be bonus depreciable.
Yeah. Let's first talk about what is depreciation, and then we'll add the bonus to the depreciation. Let's say I'm a taxi cab driver and I go buy a taxi for $5,000. I am buying this taxi for use in a trade or business. Because it has a useful life of longer than 1 year, according to the IRS. Depends. If you're buying a $5,000 taxi, probably not. But just go with me for the example here. The IRS says it has a useful life of more than 1 year. You cannot deduct the entire cost of that. You have to capitalize it, meaning you pay for it, but it's not an expense. You move it over on your balance sheet as an asset, and then we're going to let you depreciate it over the useful life. They say a vehicle has a 5-year useful life. To generalize, this is not exactly how it works. That would mean I spend $5,000 on a taxi. I get to take a $1,000 depreciation deduction each year for 5 years until I've recovered my cost. Bonus depreciation says, yeah, just like that, except instead of just getting $1,000 a year in depreciation, let's take bonus depreciation. And if it's 100% bonus, you get to write off that entire vehicle in the first year. The first moment you place it in the service in your business, you get a $5,000 deduction. That's bonus depreciation. And
John, let's get even juicier, folks. Okay, so hold on to your steering wheel.
I was going to go deep too, so I got a good question after this.
So it's a $5,000 taxi. The theory is you made money that year, therefore you could try to reduce the taxable liability on your money by just saying, well, I bought a taxi, shouldn't I be able to take that as an expense? And technically you can't take it all in 1 year normally until the bonus depreciation. Now, let's get juicier. What if you didn't have $5,000 and you wrote a loan, you borrowed money of $4,500 and had $500 deposit, and you bought a $5,000 taxi with actually only $500? would you still be able to do bonus depreciation for $5,000?
Yes, you could. Isn't it beautiful? The IRS says, look, you're going to have to pay that $5,000 back sometime, or $4,500 note back. We're going to give you credit for it. So because you're going to have to pay it back, you have basis in the entire $5,000. With that basis, you can depreciate the whole $5,000, assuming you have 100% bonus depreciation. There are times where taxi cab drivers buy taxis without $1 down. They might buy it on December 31st and take one fare out December 31st without paying $1 out, and it's an extended loan. They get to deduct the entire $5,000 then and there.
And that's a compounding effect, folks. And just to put a pin in this and finalize it before John asks the best question of the whole show, I would say, why is the IRS code the path to wealth, according to Mr. Mike Pine? I think he would say it's because the fastest way to deplete your wealth is to have major negative hits to the cash flow each year through the IRS. So I always say a person who has $100,000 and has to pay $30,000, $40,000 in taxes means that they, at the end of the year, their balance sheet says $60,000. Mm-hmm. But a family that has a business that has $100,000 and follows the code correctly at the end of the year might have $100,000 still in their balance sheet, which then helps them get a mortgage to get the next project. So by keeping the money in the business or in the family, it then allows you to compound that wealth factor to go get a bigger mortgage. And instead of it slipping out the back door each year and depleting. So I don't know if that's the point is, if you follow the wealth code of the IRS, these are major chunks of returns. It's equivalent to trying to make 30% a year on your money, which is almost impossible in a normal investment cycle.
Exactly.
So you're making it.
When you roll in the time value of money, that 30% you save today can grow to 200% 10 years from now. That's the money that you're saving. It's not just the one-time tax savings that's beautiful, although that is beautiful. It's sexy, man. You save 30% of your taxes, that is hot. But consider it. That 30,000 10 years from now can be 150, 200,000. That's the power. That's how you can grow and snowball your financial freedom, your wealth, using the tax code.
You guys both did such an amazing job articulating the bonus depreciation. And it's funny, I'm actually wearing the Capital Hacking t-shirt, and it says, our slogan is crack the wealth code. We are cracking the wealth code in this podcast. It's fantastic. Josh, you said I was going to ask the most spectacular question. There's a lot of pressure. I'm not sure that this question is going to be the most fantastic. It might be. I'll let you guys be the judge here. But, something, and I've been involved in buying real estate, my wife and I, for almost 20 years. And we've done a lot of different things. And then a few years ago, in GoBundance, we have something called a one sheet where we have our financials and everything about our life. Basically, a baseball card highlight of your life is on this one sheet. And we also, we sign an NDA and go over each other's financials. And I'm sitting there with a member a couple years ago, and we're going over financials, and he has hundreds and hundreds of rental properties, and Christina are on that trajectory. And I'm looking at it and I'm like, man, you made $1 million in passive income, and your taxes were, I don't remember exactly what it was, but it was super low. And I said, how did you save all these taxes, or have you deferred? Did you just not pay taxes this year? He said, no, I cost seg. I'm like, wait, you do what? He goes, cost segregation. I said, I've been in real estate for a lot of years, and I've never heard of cost segregation. So can you explain to our listeners who also may not understand what cost segregation, I understand it now and I utilize it now, but can you tell our listeners, please, what that is?
Yeah.
Is that the greatest question?
Yeah, but by the way, forgive me before you go, Mike. And this is the way it has to work. You have to be tough, Mike. You have to wait your turn to be fun. John has the broadest, manliest shoulders. He's trained boxers. He can probably take us down with a pinky. He has this. You have strong enough shoulders to get the pressure, John. Okay, thanks. And you delivered on it. Boom, boom. Great question. Sorry, Mike. Now it's all you, baby. If you don't answer this right, the whole audience, we're going to lose them. We're going to lose them.
Not a problem, because cost segregations are beautiful. But what is it? Let's say you go buy an apartment complex and you're running it to rent it. The IRS says residential real estate has a 27.5-year useful life. And if you've ever bought an apartment complex or even bought a house When you buy it, you only have usually one line. It's the sales price. That's what you paid for it. The IRS again says that apartment complex has a 27.5-year useful life. But they also say, but everything in the apartment complex doesn't. You've got flooring, you've got ACs, you've got toilets, you've got sinks, you've got countertops, you've got furniture and fixtures, you've got lighting, you've got electricity, wiring, all those things, laptop, all of those things, you name it. All of those things the IRS says have a shorter useful life. And if you don't go in and figure out how much you spend on those things and depreciate it faster, you're actually breaking the rules of the Internal Revenue Code. The Internal Revenue Code says you're supposed to depreciate those things faster. But how do you know? You spend $1 million on a small apartment complex or a duplex. How much money did you spend on the countertop? How much money did you spend on the flooring? How much money did you spend on the parking lot? How much? You don't know. Well, engineers do. They go through and do what's called a cost segregation study. And they used IRS's prescribed methods. There's a bunch of them out there. The IRS says, if you do this, we will agree with you and we won't even challenge what your findings are, as long as you follow these methods. You go through and, all right, let's say you spend $1 million on that duplex or that apartment complex. Well, I'm making up numbers here. 50,000 is your flooring. That has a 7-year life. By the way, it's eligible for bonus depreciation. Your countertop, same thing. Your appliances, 5-year life. That driveway, the parking lot has a 15-year life. All of those things I just mentioned are also eligible for bonus depreciation, unlike the apartment building itself. So you get a cost segregation study, then you go and have your CPA depreciate all that stuff faster, like you're supposed to do in the first place. But the IRS doesn't care if you take less deductions than you're entitled to. They only care when you take more than you're supposed to. So that's why people never get in trouble or get audited for not cost segging. You're actually supposed to, John.
Mike, look, you've given away too much gold already. So I think we should shift into either pure stand-up comedy. Mike, we'll put you on the stage, or we should shift into what it would be like to meet you. Okay. Mike, you're a great family man. We didn't even talk about that. I think your family's coming to be at this next Learn and Grow event, correct?
Not the kids, just the wife. This is going to be
I can't wait to meet your lovely wife.
Trip.
One of the things John and I are trying to do, this is live, backstage talk, Mike, John, you ready? We have this idea because we have you coming, who's extremely talented at strategy. You're a heck of a great teacher. And that's why people, accredited investors from all over the country, rely on you. And we're excited for all the hundreds of people up here to meet you face to face. But there's another celebrity coming, Matt Sorenson, who people from all over the world, country rely on for directing their IRA money, and they put their money into programs he created. So we were thinking he's Mr. What do they call it? Qualified plan. If there's Mike Pine over here, who's Mr. I can help follow the yellow brick road of the IRS code, use it correctly, keep the money in your control to build money, to build wealth. He kind of is a little bit of a counterweight to you, where he's saying maximize your IRA contributions, put them in a Roth, and then buy assets. I'm sure you're fine. You're fine with that. It's not like he's saying heretical stuff. But the question John and I want to parse, and we want to have you guys go head to head in a death match on, should you buy real estate in your IRA or should you not buy real estate in your IRA, John, right? Is that what we want? We want these guys to go, crash into each other. And then us as an audience will do a bulls versus a bear. John, is this the right question to ask these guys? I don't want them to give the answer now.
Well, we're going to come up with quite a few. And we're also, Mike, we're going to give you and Matt a heads up. So it's not going to be like questions that are out of left field that you don't feel comfortable answering. But
wait a second. Wait, you're not allowed to do that. The presidential debate should be fresh.
Absolutely.
I think for it to go smoothly, the way I've seen it in the past is they do get the questions in advance. So they are fully loaded and ready. But so Mike, the thought that Josh and I have is a bull versus bear. You'll be on one side, Matt will be on the other. I think I'm probably going to be the one to facilitate. So I'll be asking each of you questions. We're going to go like a boxing match. It'll be like, we'll just do maybe 3 rounds, maybe 4 rounds, maybe 5 rounds. I don't know. But we're going to have rounds. And I've done this before, by the way. I did a vegan versus a carnivore.
That's a good idea.
Which is better, which was like one of the highest rated things that we did. But so I ask questions, and then after round one, the audience will have flippers, and they'll hold up their, on who wins each round. So it's just going to be a lot of fun, a lot of information.
Hi, this is Melanie McCallan. Josh and I are just so grateful for the many investors who have already joined us at Accountable Equity. Accountable Equity is so much more than a capital group. It's really a community of accredited investors that want to learn and grow together. I just want to personally invite you, if you want to find out more about this type of investment and see if it's right for you and your family, please visit us at accountableequity.com. You can fill out the contact form. We'll get right back to you and see if this is a great fit for you and your family. We'd love to meet you. We look forward to learning about you. Please visit us at accountableequity.com.
Hey, it's Hal Elrod, author of The Miracle Morning, and you're listening to Capital Hacking. Enjoy.
Sounds like fun, but the tax guy is going to be the bull. It's that retirement guy has to be the bear. So
I like it. We'll do that.
I'll bring my horns.
Bring them, please. So yeah, dude, we're going to have so much fun with this. And anyway, I mean, the other big thing that we could do here at the end, because I feel like you're giving away so many golden nuggets. I think everyone sees why you're one of the keynote speakers, and I love the fact that you're bringing. It's like this. You're doing another thing that you're bringing the scale of when you were at PwC and you're watching billion-dollar funds use the IRS code correctly. You're saying the reason the junior company, the small family, doesn't use those is because they don't have access to these amazing strategists, because the strategists have gone up level to the fund level. And so this is the question that if you and I hadn't met, if I haven't met other entrepreneurs that understand strategy, I might be confused. So can you explain to me, why are CPAs right around the corner here not talking the way Mike Pine is talking, right? That you both have that 3-letter did at the end of your name, but they're telling us, I can help you do your taxes, and they're doing nothing illegal, and it's coming up with a big tax consequence. And you're saying, I'm using the tax code and it's a different tax consequence. Both are legal. Why are you guys thinking differently? And why can't we just go to any plain vanilla CPA and get the same work?
There's a big difference between a tax preparer and a tax strategist. The type of people that are attracted to the accounting profession, again, I wasn't one of those, thankfully, but the type of people who are attracted to the accounting profession, they want everything to fit nicely in a box, neatly in a box. You go to school to be a CPA, they teach you how to put things in the box in the right order. They don't tell you to think outside of the box. And that's just sad. I've got a lot of colleagues that are CPAs that can't stand what I do. They say, that just takes too much thinking. That's not fun. Let's just go move numbers on the box and prepare a tax return. I think they've got to be bored out of their mind. I don't know how they aren't, but what we do is strategy. It's a lot more fun. When you consider what they have to learn to be a tax preparer, it's less than 0.5% of the entire tax code. That's what you go to the pages that say, this is what in the tax code, how much you have to tax something. This is the assessment or the percentage of tax or the levy. That's less than 0.5% of the tax code. You can learn those pretty quickly. The other 99.5+% of the tax code, that's where the good stuff is, man. That's where the incentives are. And the incentives, you might read through them, they're a little bit confusing. You gotta take a big picture view. Most CPAs, we're not taught to think big picture. Focus on the number. Focus on the line on the tax return. Be myopic in your view. To understand the incentives, you got to take a big picture view. And just so happens, I should have never become a CPA, according to most people. But because I'm an outside of the box thinker, oh man, the tax code is glorious, dudes.
I'm curious here. A friend of mine is also very, very much like you. He's a big, well-known CPA. And I remember one time he wasn't feeling good for like 4 days, and he read like 970 pages of the tax, the tax book or whatever. Do you do this in your spare time? Because I know he does. He geeks out and he does very much, like, he helps people like strategize, and that's his thing. But I couldn't wrap my head around doing 10 pages, let alone 900 some pages.
Yes, close friends of mine, when a new tax bill comes out and they find I'm reading it until 4 a.m, or a new tax law has just got passed by one of the houses, or they'll say, "Ooh, Mike porn just came out." That is what I love to read. That's good stuff, and there's a lot of good value in it.
You know, there's this other. Oh man, I had this fun idea, but I got so engrossed in that idea.
I got a question. I
had a fun idea.
Locked and loaded for you, Mike. So, you know, again, just people that are just getting into tax strategies and entrepreneurship and all that good stuff and looking to save some taxes. What are some of like the podcasts or books or resources that you would recommend to a newbie?
Hiddenmoney.com is our podcast trying to change people's paradigm of the tax code. I would highly recommend it. Hiddenmoney.com.
Yep. That's awesome. And then books.
See,
any books or no?
I think Wheelwright writes some great books on tax. So Tax-Free Wealth is a great book. It'll get you started. There's so many books out there. A lot of them go on these trails. But
even for the total rookie, maybe Rich Dad Poor Dad. You know, because in that his whole point is that there is another way to understand reality. Yeah. So that helps people question that you could find a CPA like Mike Pine. You know,
and Wheelwright was the Rich Dad Poor Dad CPA, and that's where he built out his great education stuff. Good stuff.
Well, the thing I wanted to say here is hopefully this is a taste of the enjoyable time with Mike and how great it is we get to meet his wife. But the thing that I would say is because of that exposure you received, mixed with your outside the box, more liberal art minded kind of strategy, you're a rare bird. It's a real privilege and an opportunity to find a person like you. And some people are going to choose to partner with you and join forces and become part of the firm. As a client, because, for a modest amount of cost, they get access to people that have been doing this strategy for 25 years, 30 years. And that's the opportunity. And that's what do you call that? Proximity and access. And that's why I'm so excited about what you're doing with your free podcast, with your willingness to come and meet some of your clients and some of the people that you've helped. Everybody at Accountable Equity has been helped by the code strategy work we did before we raise money and how we try to give it as much maximum power to them. So I would say, to me, I'd like for everybody to know how to reach you, Mike, because as we wrap up here, if you have final thoughts, how can they follow up? We've gotten Hidden Money. What's another great way?
That's still the best way. Go to hiddenmoney.com, find the action button that says reach out to us or contact us for a consultation. That's where to go. That's where you'll find us, hiddenmoney.com.
Mike, I just personally want to thank you because there's always like a question or two with how many investors we have. I'm like, I don't know how to answer that. I'll contact you as a teammate, and you're incredibly easy to understand. So thank you for all that.
Thank you. It's a pleasure. And it wouldn't be fun what I do if I didn't actually have the opportunity to work with people like you who do this stuff to save the taxes. That's where the rubber meets the road, and that's where it's fun. So thank you.
We're going to have a great time in person, baby.
Oh, yeah.
Looking forward to it. Thanks, Mike. Cheers.
Thanks, guys.
Damn straight. We just got we got to the end of another great show. And everyone listening right now, you're the family and friends. Thanks for staying till the end.
That was so fun. And hey, hit the like, hit subscribe. We're here to serve you guys. That's why we're doing this show. Josh is not paying me. I'm doing this off of my quote unquote sweat equity because we want to make a difference in your life. And then that ripple effect will continue to touch the world.
Hey, amen, brother. Please check us out on capitalhacking.com, all the social media threads. And yes, I know you've probably already sent this episode to one of your best friends. Thank you. We love you. Just go right into your iPhone, hit the plus symbol. We'll talk to you later. See you next week.
Share.